Good morning. Welcome to the Harbour IQ webinar series. Today's topic is maximizing tax savings for the tool builder. Last July, Harbour Results launched Harbour IQ, a manufacturing business intelligence tool, the source for global tool and die industry data. Our partner today, Mike Deverell of Muller Prost, is our featured speaker. We have a few housekeeping tips. Your mics should be on mute. Questions will be taken at the end, and Mike will send out a PDF of the webinar. And with further ado, I want to introduce Mike. Mike, welcome.
Good morning. Thank you, Mary. I appreciate the opportunity to work with all the folks at Harbour Results. I've known them for years, and really was happy to join as a partner of Harbour IQ, and really just look forward to sharing some information about the research credit. There's about as exciting as things as you can get with respect to tax law, as it relates to this research credit in some recent Treasury regulations and a bill that passed this past December. So we're going to go into some of those things today, because for those of you that have met me, I do have certainly a passion for tax and tax law and helping manufacturers, and this was really taxpayer-friendly developments we've had over the last couple of years. So we're going to talk about that quite a bit today. So here are the topics we're going to cover. We're going to discuss, how and why do tool builders qualify for the research and development tax credit. Often I get comments of I'm not expanding the knowledge in the industry. I'm not doing things that other people aren't doing. I'm generally certain that I'm going to be capable of developing and producing a tool to meet my customer specifications. But that doesn't mean that you're not performing qualified research. So we're going to talk about those. We're going to talk about the activities that qualify for this credit. We're going to talk about the expenditures that underlie those activities and why those expenditures meet the definition of a qualifying expenditure. And then finally, we're going to talk about both the Treasury regulations that have come down the pike over the last couple of years that candidly have just been very, very taxpayer friendly. And then we're also going to talk about new legislation. It not only made the research credit permanent, but also improve the way companies can monetize this credit. One of the big hurdles for small and middle market manufacturers in the past has been the alternative minimum tax. And that's beginning in tax year 2016, that's not going to be a hurdle for eligible small businesses, and we'll talk about that. And then finally, startup companies may be able to offset payroll taxes with 2016 credits beginning in Q1 of 2017. So we're going to cover each of those. So without further ado, let's kind of jump into an overview of what is the research and development credit. First of all, it's governed by Section 41. It's based upon qualifying activities. And then within those activities, there's going to be different expenditures associated with those activities. And there's three types of expenditures that meet the definition of an eligible expenditure. If you're looking at prior years, any refunds received from the IRS are tax-free. If you're in a state that has a research credit, those refunds are not tax-free. They're taxable. However, they can be quite significant. Some states have a credit as much as 20% or more with respect to their qualifying research expenditures. So that's the whole premise here, is the qualifying activities. So what is a qualifying activity? Well, there's 4 requirements. The first is that I have to be developing or improving a business component. And business components can be defined as products, processes, techniques, formulas, inventions, or software applications. So what we're going to talk about today is mostly products and processes. You all on this line are developing new products, new processes. Now, the products that you're developing are typically in the form of a tool. And I know there's some injection molders on the call as well. So you've got a couple of different processes as well. You might be helping with design with respect to manufacturability of a part. But essentially, you're all going to be involved in the development and the production of a tool associated with either injection molding or extrusion or other machine components. So this first component of the definition is product or process. It doesn't necessarily mean that I have to be developing something and then putting it in my finished goods inventory and then trying to hold it for sale. Almost all of you on this call are custom manufacturers. You develop something that's novel, unique, one of a kind. That meets the definition of a business component. Second requirement is it has to be technological in nature, meaning the activities themselves fundamentally rely upon the engineering disciplines. That's not to say that I'm required to expand, exceed, or refine the knowledge in my industry. I'm entitled to rely upon existing engineering principles in order to solve for an unknown or an uncertainty. And that just means more than one alternative, because uncertainty is defined in three ways: capability, method, or design. That capability is associated with, is this possible? Has this been done before? Can we even meet these tolerances that would be necessary in order to produce this tool? Method might be, how? How am I going to develop end-of-arm tooling associated with this production process? How can I design a fixture that'll help me meet my tolerances so that I can put this on a 3-axis machine instead of a 5-axis machine? How can I evaluate the performance of this manufacturing process and improve upon it? Maybe I want to reduce cycle time. And then finally, if the design is uncertain, the appropriate design is uncertain. Now, this is where we find a majority of the dollars. Then you've got a qualifying research activity in the elimination of the design uncertainty. Because the appropriate design of the business component just means there's more than one alternative. So for you mold builders, how many cavities is it going to have? How do I plan on ejecting the part? How am I going to design this to eliminate flash or short shots? Am I going to have to add venting here in order to make sure that I don't have short shots? Is there going to be a problem ejecting the part? Maybe I have to increase the draft a little bit in order to get that part to eject. These are all things that you're dealing with on a regular basis. And as long as you're eliminating that design uncertainty through a process of experimentation, it can be a qualified activity. Now, the Treasury regulations define process of experimentation to fit your industry: modeling, simulation, or systematic trial and error. Modeling is AutoCAD, SolidWorks, whatever modeling software you might be using. Simulation, perhaps you're doing mold flow analysis in order to simulate that resin being shot into that mold, or the resin being extruded through that die. These type of things are all defined as qualifying activities because that's the process of experimentation. And systematic trial and error tends to be everyone's favorite because it's almost a catch-all. That's just how things get designed and developed. You think about things and how are we going to go about achieving this? How can I design this tool to meet my customer specifications? How can I design this part-specific manufacturing process to meet this design criteria that you're going through on a regular basis? And this process of experimentation is the qualifying activities that we're talking about. Now, here are some examples of qualifying activities. You could be designing new tools, developing new functionality or performance specifications. Perhaps you're trying to improve cycle time or developing tool-specific fixturing. For you injection molders out there, perhaps you're designing your own end-of-arm tooling, in which case, many times the materials associated with that end-of-arm tooling and the labor can count with respect to end-of-arm tooling that I'm developing in-house. If you're experimenting with new alloys, materials, or other resins, then those could be qualifying activities. Perhaps you're testing different viscosity or surface areas on a mold. Those sort of things can be qualified. And then, of course, you don't know that you've eliminated that design uncertainty until it's gone through PPAP or first article type inspection. So the quality department many times gets involved in research, and that research clock doesn't stop until I've eliminated the design uncertainty. So let's shift gears for a minute. We've been talking about the activities. Let's talk about the expenditures that are eligible. The first one historically has been the largest. That's activities of the employees spending time performing research, so actually engaging in the process of experimentation, directly supporting research. So perhaps I've got somebody out on my shop floor that's producing the first one-off non-capacity tool associated with the design of a first-of-a-kind tool. Well, they're directly supporting the research efforts because there could be an opportunity or a a challenge associated with meeting a specification, and I have to maybe go back and modify that tool. Like example I used earlier is maybe I have to increase the draft because the part's not ejecting. Or perhaps I need to add a water line to cool the mold faster. These things, until you've got that design uncertainty eliminated, you're in research world. Your activities are in the performance of qualified research. Now, the second category of expenditures has grown quite significantly over the past few years, and that's due to a couple of court cases. One was actually an injection molder in Missouri. TG Missouri won a court case where they not only included the cost of the development of a mold, but they included all of the costs associated with new tools when they paid a third-party tool maker to produce that tool. And so what does that mean? That means that they would come up with a tool design and go to the third-party tool maker. Many of you are on the line, would produce that tool. He'd bring it in-house and he'd experiment with it, and then if it meet the specifications and produce a part that met the customer specifications, who was Toyota, by the way, then they would sell that tool to the customer. Well, they got paid for the tool. They sold the tool, but they were at economic risk for the development of it. That was the key. If they couldn't make a part that met Toyota's specifications, then they didn't get paid for the tool. And the payments they made to the third-party toolmaker, they were at risk for. They had to pay that third-party toolmaker regardless of success or failure. Well, that translates not only into the injection molding world, but it can translate to tool builders. Until you've eliminated the design uncertainty, you could be including expenditures such as raw materials or components of a particular tool that's unique, novel, one of a kind, and as long as I'm cutting steel and my design, I have not met that specification yet, I have not proved that my design is uncertain, it's qualified research. So the supplies used in the conduct of research has grown substantially in the last couple of years. That started with TG in Missouri, then Trinity Industries. Trinity Industries was a shipbuilder. They included the entire cost of the ship because they were experimental. And the Navy paid them for the ship, but the payment was contingent upon them meeting the spec. And it was qualified research. They got to include the cost of some of those ships, the ones that they could prove that research was taking place anyway. And then contract research. That's where you pay a third party to perform research on your behalf. Now, that third party could be a heat trader. It could be an independent contractor who you're issuing a 1099 to. It could be a testing facility. Perhaps you got somebody else doing the sampling or the trial out of the tool, and you got to pay them a fee to do so. Though it's really when you're paying a third party to perform research on your behalf, I get to count 65% of those costs. So those are the type of expenditures that are really eligible here. So let's talk about some integrated tax planning ideas. The first one I don't expect many of you to be familiar with. In fact, 90% of the CPAs that I work with in this area are not familiar with it. 41G is a way to offset the alternative minimum tax. And so those of you that have been familiar with the credit and have perhaps claimed it in the past, you've got this limitation of not only the income limitation, I've got to offset tax that's being generated by the entity or attributable to the entity, but I've got this alternative minimum tax provision out there. There are ways to offset the alternative minimum tax. And I'm not talking about that blue light special we had back in 2010 that allowed eligible small businesses to offset research or offset the AMT. And I'm not talking about 26 and thereafter, which eligible small businesses will be allowed to be offset AMT. I'm talking about instances where I generate more credit than I do tax attributable to the entity. Now, any unused credits, when they're carried back or forward for 20 years, if I flunk that income limitation in the year the credit's generated, I can offset AMT. Well, that's huge. We've gone into companies and not increased their credit at all and have requested refunds rather than carrying those credits forward. And that's important. That kind of dovetails into this credit utilization analysis. You know, if you're a flow-through shareholder or a flow-through entity, an S corporation or partnership or an LLC, you know, passive shareholders are treated differently. For those people that own the business that aren't in the business, you've got different considerations. It would take me 20 minutes to go through that, so in the interest of time, if you have that set of facts and circumstances, shoot me a note or give me a call. Happy to walk through what those pitfalls might be, and then maybe some planning ideas to help mitigate any additional tax that might be associated with that. There's a revenue procedure that allows me to adjust carry forward. So if you haven't claimed the credit in the past, or perhaps hadn't claimed enough, perhaps we can adjust our carry forwards into open years. State credits, as I mentioned earlier, there's about 35 states that have a research credit as well. And the states that do, they range everywhere from 1% up to 24% down in Arizona. I looked at the list. I didn't see any of you were in Arizona. Perhaps I think I saw maybe one of you out in California. California's got a pretty nice credit. But these state credits can be quite substantial as well. The next two bullet points are interaction with things on your tax return. So when you're looking at these things, you can't just do a credit study. You can't just go out and work with somebody that just knows the research credit. You have to, in my mind, integrate things together, because that first bullet point there, that 263 capital A, that talks about the requirement of capitalizing some of your indirect costs into your inventory. However, I just told you a moment ago that some of your material costs and even labor for construction may be qualified research expenditure. Well, research is excluded from that calculation. So any identification of research might help you deduct some of these expenditures at year end that historically I might have had to capitalize in the inventory and then not be able to recognize as a cost of goods sold. That's not anything that's permanent tax savings, but it could be timing. You could be deferring some of your income for the following year. Interaction with the domestic production activities deduction. That's that last bullet point down there. For those of you that don't know, there's a what's called a manufacturer's deduction. I get a deduction equal to 9% of my taxable income associated with manufacturing activities in the United States. That equates to about 3% reduction. Well, in determining whether or not I have the benefits and burdens of ownership with respect to a mold, many times you have to look to whether or not I've got vendors that are associated with it, or perhaps my customers are the ones that might be at risk and might be have the benefits and burdens of ownership of that tool. But many times it's you guys, it's the tool builders, it's the injection molders that are eligible for this deduction. And there's interaction, there's interplay with the research expenditures. So that's something that you're going to want to be able to know and integrate into your planning to really maximize the benefit of this research credit. So let's talk about some new regulatory guidance. We had a number of developments with respect to new Treasury regulations over the last 2 years, essentially. This started back in September of 2013 when the IRS issued that some Treasury regulations with respect to the alternative simplified credit. Now, if you've looked at the credit in the past, and especially if you looked at it prior to 2007, you had this notion that I had to go back to 1984 to 1988 to calculate what my research expenditures are, and I had to know that information applying today's definition of research. Well, that's darn near impossible unless you're using estimates. Which, by the way, estimates are allowable to compute expenditures if I can prove that research is taking place. But this new alternative simplified credit really allows taxpayers to claim a credit when they're not increasing your research activities at all. I could be spending the same amount on research each and every year now, and I can qualify for a credit. Let me explain. If I spend $1 million on research, and I'm just using that number so we can all do the math in our head, but if I spend $1 million on research, this is a credit for increasing your research activities, and I have to increase over a base amount. That base amount under the alternative simplified credit is equal to 50% of the average of my prior 3 years. So if I spend $1 million every year, well, that base amount's $500,000, 50% of the average. Well, I spent $1 million this year. I subtract my base amount, so I have $500,000 multiplied times a credit rate of 14%, and I just got a $70,000 tax credit, dollar for dollar credit against my tax liability on my $1 million of expenditures, and I didn't increase at all. So this credit for increasing your research activity actually rewards companies that are performing research regardless of whether it's an increase or not. Second category, our second regulatory guidance here is probably the most impactful to your businesses. And that said, they issued new Treasury regulations under research expenditures that said it's irrelevant whether the results of your research are sold to a customer or used in your business. That is huge, because what that means is if the design is uncertain at the time I'm constructing my tool, and I even end up selling that tool, it's the pilot model, it's the prototype in a sense. It's the first time I designed and developed that, and the research was the design was still uncertain, then that can qualify, because as long as the terms associated with the purchase means that I had to meet the specifications. I'm sure many of you on the call are thinking, well, boy, I'm not going to get paid unless I can meet a specification. Well, that means you're at risk, and therefore you can include some of these expenditures, whether that you've thought of that historically as a cost of goods sold, or whether you've included that as a research expenditure. For you injection molders out there that are either developing your own tools in-house, you can include the materials and labor as well, or if you're paying third-party tool makers like TG Missouri did, then perhaps those payments to third-party tool makers can qualify as well. Again, that can be significant. That's why we've seen these supply expenditures grow so much over the last few years with respect to tool builders' research credit claims and injection molders' research credit claims. I shift gears here for a moment to the development of equipment internally. I use end-of-arm tooling as an example pretty regularly because if I'm designing and developing that in-house, of course the design and the timing of such associated with the improvement of that manufacturing process, that can be a qualified activity. And so the material costs associated with that can be qualified. Now, if you're hiring a third party to come in and develop this and it's plug and play, you're not going to be able to include that. That risk is being put on somebody like a Star Automation or Yushin or someone like that. But what I'm saying is if you're developing that in-house, there's a potential for that to qualify for the credit, and there could be a possibility that you don't have to capitalize it, and you get to deduct it in the year that the expenditure was paid or incurred. So this second bullet point is really significant, and we've seen a lot of taxpayers' research credit claims grow quite significantly. Finally, internal use software. This past January of 15, we saw some new rules. Finally, as we've been waiting for these rules for over a decade with respect to internal use software. So if any of you are developing software, I know this is kind of narrow, but if any of you are developing software that interacts with third parties, so interacts with your customers or your vendors, then there's a potential for those software development expenditures to qualify for this credit. By the way, if you are doing that, you probably don't have to capitalize software for tax purposes either. There's a notice from 2000, a revenue procedure from 2000 that allows me to expense those development activities. So let's shift gears to new legislation. This just passed on December 18th of 2015. For those of you that know me, you probably know that I was dancing in the streets when this occurred. Every couple of years, we have to wait out Congress retroactively putting this credit back into place. As many of you know, I spend a very significant portion of my time with respect to this credit. So making it permanent stops the waiting each year of them retroactively putting it back into place. It also throws fiscal year taxpayers, those that don't have a December 31 year end, through a fit of having to amend returns or extend their return if they don't want to, and so forth. So this is a really good development. It's going to allow taxpayers to start planning for the research credit and utilization of the research credit. So I'm really pleased to share that with you. The second is probably the second largest, if not the first largest development, and that's the eligible small businesses. Those businesses that have, if you look at the prior 3 tax years, if they're less than $50 million, so that makes me an eligible small business for that tax year, I'll be allowed to offset the alternative minimum tax with credits generated in that tax year. Let me explain. Let's say I had a alternative minimum tax liability of $120,000, which the AMT is just a second set of tax laws in the U.S. So I pay the regular tax or I pay the AMT. I pay the greater of the two. And let's say, for example, I've got a $120,000 tentative minimum tax liability. My AMT is $120,000, and my regular tax liability is $150,000. Well, I can only utilize under the general rules. I remember I told you there were some exceptions to this. Under the general rules, I can only offset $30,000 of tax, and then the rest can be carried back 1 year or forward for 20. Under this new law, that AMT limitation is no longer in place, and you can monetize those credits that you're generated a whole heck of a lot faster. This is going to be really beneficial and will allow cash flow to really be recognized as a result of these tax credits. Third change, startup companies. So what's a startup company? Startup company is somebody that has not had sales for 5 years or more. So if I started my company 3 or 4 years ago, the chances are I don't have 5 years of gross receipts, as well as if I'm less than 5 years old, then I'm deemed to be a startup company. And beginning in tax year 2016 for calendar year taxpayers, then that 2016 credit is I can elect in that first quarter of 2017 to offset my payroll tax liabilities. So now if I meet the definition of a startup company, I don't even have to have taxable income anymore. That can be quite significant for some of these startup companies. Some of you on the call may or probably don't fit within that category, but certainly was part of the PATH Act associated with this. So this development was really huge. Now, this legislation, just as an FYI, did include some other things. It included the many of you are familiar with Section 179. That's now permanent fixture of the code at that $500,000 level, and it's indexed for inflation. In addition, they extended bonus depreciation for 5 additional years. So there's a lot of goodies in there. For those of you that read Mold Making Technology, I've got an article coming out in February in that. I've got a monthly column that I write with them, and it'll explain all about it. So I think that is, we flew through a whole lot of information really quickly. I wanted to be cognizant of everyone's time this morning and make sure that I could give you some impactful information to kind of really get you thinking about this credit and how beneficial it can be to your business. So with that, I will turn it back over to the Harbour team to field questions and so forth.
Okay, so if you have a question, feel free to hit the chat feature or type it in, and it'll go directly to Mike. Let's give it a few minutes. Okay, Mike, I have one question here. Can the credits I generate in 2015 or earlier years offset the AMT in 2016 and thereafter?
That's a good question. Unfortunately, they can't. The credit actually has to be generated or claimed in a tax year ending after December 31st of 2015. So if I'm a calendar year taxpayer, the credit in 2016, 17, 18, and so forth, those credits can offset AMT. And in fact, earlier I mentioned that the credit can be carried back 1 year or forward for 20. The 2016 credit that I generate, if I can't utilize all of it in 2016, I can carry that back to 2015, and I can offset the AMT there. But it's only the AMT turnoff, so to speak, is only related to credits generated in 2016 and thereafter.
Oh, okay. Well, I think we got time for one more, and this question asks, how many years can I go back to claim credits in earlier years?
Well, the general rule is the current year plus the prior 3. So either if you claim the credit and perhaps want to claim additional credit, there's a possibility to go back and review that. Perhaps I haven't claimed the credit at all, and I want to go back and I want to amend my tax returns and claim refunds. The general rule is the prior 3 years plus the current year. So what does that mean? Right now we're looking at tax years 2012 through 2015. However, I do want to point out that I can adjust my carryforwards. And those are carryforwards are tax assets. They're things that I paid for already, but I didn't get the benefit of from an income tax perspective. And so let's assume for a minute that I had a loss in 2010, I had a loss in 2011. So 2012 is an open statute year. I can get refunds from 2012. I can actually look at my 2011 tax year and see that well, I had a loss. I didn't pay any tax, but I was eligible for $30,000 in credit. I generate the $30,000 in credit, and then I look to see, well, can I carry the credit back to 2010? And then in the event that you carry that back to 2010 and can't utilize it, then that can carry forward to 2012. Well, that means that I can adjust my carry forward associated with the credit that was generated in 11, and I can carry that into 12 and get some cash flow.
Well, great. Mike,
Marion, I got one more question that came through.
Yeah.
And that is a question that just came about. Explain about taking the entire cost of a new mold, even if the customer's paying for it. So there's this concept of economic risk associated with the research credit. I have to be at economic risk in order for the expenditures associated with that. So let's assume that one of my customers says, hey, I'm going to pay you $150 an hour to design this tool for me. And he's just going to, I've got kind of an open checkbook, and he's going to pay me regardless of success or failure. And that $150,000 he's paying me an hour, that's funded by my customer. I don't get to include the hours associated with that activity. Let me contrast that, which says that if I have a customer that comes to me and says, here's a design of a part, I'd like you to develop a tool that's going to meet the specifications and produce a part that's going to meet the specifications of this part. And let's say they're going to pay me $60,000 for that tool. Well, now I could spend 100 hours or I could spend 1,000 hours in the design and development of it. I've got, for lack of a better term, make good provisions within that. They're not purchasing time, they're purchasing a result. So the whole process, the whole tool or project itself is not funded research. So that means that a customer could pay for something as long as it's contingent upon me meeting their specifications and success. I'm at economic risk. So let's now talk about the expenditure side of that. If I've got research expenditures, so I'm designing and developing that tool, and for those of you that claim in the credit, you may have been claiming the engineering or design time associated with that, and then when it goes over to the shop floor, then you might stop that research clock. But what happens if you had things that didn't work the first time? What happens if you had modifications that had to be made? You had to increase the draft. You had to add a water line. You had to perhaps scrap the whole thing, heaven forbid, if it doesn't meet the specifications. In those instances, the design is uncertain. So then you have to ask yourself on each one of these tools, is the design uncertain at the time I'm constructing the tool? And if it is, then I've got a qualified expenditure and the research clock is still going. And those expenditures incurred prior to the elimination of that design uncertainty is qualified research. I hope that answers your question. If not, we can certainly, like I said, I'm happy to be a resource for any of you. You can call me anytime. Yeah, my cell phone number's on there. That generally is the best way to reach me. In fact, I'm leaving for Hartford, Connecticut tomorrow morning. So, like I said, cell is usually the best.
Well, Mike, I want to thank you for taking the time to present this morning, and I also want to thank folks for joining us for our first webinar series. Harbour IQ will be conducting more webinars, so stay tuned for the next one, and just watch your emails. And Mike, thank you so very much for delivering what I think is a most informative presentation on how they can maximize tax savings you know, going forward in 2016. You guys make it a great day, and Mike will be sure to send out a PDF of the presentation. Thank you.
Thanks, everyone.